The Global X Nasdaq 100 Covered Call ETF, an 11.80% dividend cash cow, but does it live up to the hype? Thank you to Saud for the suggestion as well as the feedback. Stock ticker QYLD, the Global X Nasdaq 100 Covered Call ETF generates large amounts of income for their shareholders by implementing a covered call options strategy on the Nasdaq 100 shares they own. QYLD is currently trading at a share price of $23.06 with a 52-week range of $20.51 to $23.58. Unfortunately, however, the fund is trading at a premium, meaning the current market value is greater than the value of the total underlying investments. This is exemplified through QYLD's $3.35 billion in net assets, which results in a net asset value or NAV of just $22.69. Also, remember that beta metric of 0.72, which illustrates the price movements of QYLD to be 28% smaller than that of the Nasdaq 100, or the index which they track. This will be a very important financial metric for later when we break down whether or not this ETF truly does offer the most ideal returns. Said returns come in way of large distributions at a rate of 11.8%, leaving you with an annual payout of $2.72 per share, which is paid monthly. Unlike other funds which host such high yields, QYLD only has an expense ratio of 0.06%, which is something we love to see. Additionally, they have continuously made these distributions for 7 years running. With that being said, however, QYLD has struggled maintaining consistent payout prices, but they have begun to even out a bit over the past year. In order to understand how Global X is able to capture such high dividend yields within this fund and whether or not they can maintain it, we must understand what stock options are. Options contracts are a contract or an agreement between two parties to enter into a transaction involving a specific security at a predetermined time and sale price. There are two types of options: call options, which we will be focusing on today, and grant the contract holder the ability to purchase 100 shares at the agreed upon or strike price from the contract writer or person selling the contract. Put options are the exact opposite, giving the contract holder the right to sell 100 shares to the writer at the strike price. It's also necessary to know, and really the whole reason why this strategy works, is because the party purchasing the options contract must pay an options premium to the writing party. This premium represents the price paid for the party holding the contract to maintain the ability or option to exercise it at any point within the given time frame. QYLD's distributions are driven by income generated from a covered call option strategy, not to be confused with a naked option strategy, wherein the contract writer does not own any of the underlying shares. Global X first purchases shares of the Nasdaq 100 in lots. They then write call options on the positions they hold, and the options premiums, which they earn from writing the contracts, are passed as distributions back to the QYLD shareholders. Once the call options are sold and the options premiums are received by QYLD, there are essentially two possible scenarios which may take place. The underlying share price decreases, resulting in an out-the-money contract, as the share price has not exceeded the strike price. In this case, the contract will not be exercised. QYLD keeps their underlying shares as well as the premium from the contract sold. If the share price of the underlying stocks continues to rise, exceeding the strike price, the in-the-money contract will be exercised, forcing QYLD to sell their underlying shares at the strike price. This brings us to our first problem with QYLD. Their upside is capped. If the fund only ever sells their positions when the covered call options are exercised, they will always only ever receive the options premium as well as the money received from the price appreciation between their original cost basis and the strike price. This creates a large opportunity cost for the Global X fund, as they can never realize substantial price run-ups. Remember this when we compare them to another fund later on. You now know how the QYLD dividend is generated, but how does it perform in addition to the income stream they provide? Over the past year, 3 years, and 5-year periods, the fund has returned 20.35, 9.15, and 11.46% respectively. These returns are driven by large investments in both the technology and communication services sector, which account for 65% of the QYLD portfolio. The top 10 holdings, which make up 56% of their total total assets are led by Apple at 11.41%, Microsoft at 10.18%, and Amazon at 8.67%. Now, QYLD's top 10 holdings are almost identical to the Invesco QQQ ETF, stock ticker QQQ, which also tracks the NASDAQ 100 index. The reason I bring this to your attention is because the annualized returns of QQQ consistently have been able to almost double that of QYLD, posting 1-year returns of 29% and 3- and 5-year returns of 27%. This is further exemplified by graphing portfolio growth of a $10,000 investment over the past 7 years, or since the inception of QYLD. The red line, QQQ, saw the largest compound annual growth rate at 22.14%, while QYLD's 9.04% annualized returns failed to beat out the 15.5% offered up by SPY and the S&P 500 index. And I do want to be clear that this calculation does take into account reinvesting those QYLD dividend payments. If the final balances on this graph don't sell you on the fact that QYLD is overhyped and QQQ is a much better choice, I will leave you with one parting thought. Most of the income generated from a position held in QYLD, it will be taxed at your ordinary rate as it comes in the way of dividend payments. Not only are you subjecting yourself to diminished portfolio growth, but you will also be opening yourself up to a higher tax burden on your already lessened returns. Let me know in the comments down below why you believe the QYLD hype to be true, and don't forget to subscribe to the channel. As always, I'm Patrick Zimmerman. Thank you for your time, and have a nice day.